Right, everyone. Hello, hello. Welcome to the Sleep Well Portfolio and Awake monthly meeting. We're going to go through allocations, what's going on in markets, macro environments, where's the trades, where's everything going. Try to answer some questions and put a nice bow tie on everything that is going on in the markets. So, without further ado, I do have to get into some of the legalese. So, let me just knock that out really quick. Environmental Trading Edge LLC and its members are not broker-dealers or financial advisors. Past performance is not indicative of future results, although some results have been great and it's been amazing, and they look like they continue to go that direction. But remember, past performance is not always a guarantee of future results. This is for personal use only. If you are a commercial use or if you're a financial advisor or an institutional client, there are many of you guys that watch these. Just reach out to me. We can work something out and make these available to your clients and do it the honest way. All right, guys. With all of that said, let's just dig into about typically how we'd run these meetings if this is your first time. The current allocations are our first thing that we deal into, just kind of where things are for the sleep well and then also the awake. Two very different strategies that are still based on the macro. One is a little bit more, let's say, conservative and diversified, right? Takes significantly less risk, but is a little bit more steady Eddie. The other one, which is the awake, is an augmented version of the original and deals with a little bit of extra calculations to try to get ahead of the curve. So far this year, that has actually kind of hurt us a little bit. So we'll dig into that. And then, of course, there are some years that it does a chunk and it makes us a lot more money. So cuts both ways. There is a significant leverage portion of the awake. So we'll kind of talk about that because there have been some questions about the leverage under high water because the Sleep Well portfolio just recently hit a new high. And so it just deleveraged for some significant gains. So we'll kind of talk about all of that as we go through here. And then we'll go through the performance analysis of each individual asset, which that's going to be this SPY, the IWM, gold, TLT, UUP, EEM. Really wrap those up and kind of see what's going on in each one of them, what they've been doing and how they've been performing over the recession. And then we're going to go into a macro analysis of really answering the questions of what is going on, what has been going on, what is likely to continue going on, and where we are in the cycle, where we are in the next step of the cycle. And then, of course, we can open it up for questions. As always, though, if you got a question midway through and I catch it, I will, of course, answer it. I don't typically leave them out there for too long, but I go back and forth between checking the chat box and then going between the presentation. So if there is anything, let me know, and I will see. Which, speaking of that, let me just make sure nothing has popped up yet. All right. We're looking great so far. And no one's let me know of a technical issue. Sometimes I do run into some sort of random technical issue, but, that's part of live streaming, right? All right. Now, first and foremost, let's go through the current allocations in the Sleep Well portfolio. The Sleep Well portfolio has been a little bit more diversified than the Awake. It's been really great. The thing is that it's not your typical like 60-40 right now, albeit we do, roughly speaking, have about 60% at risk right now in stock-based assets. But instead of it being predominantly in bonds or something like that, we actually have a lot of dollar and a lot of TLT. Now, there for a little while, we were in gold for quite a bit, but the cycle was starting to turn the other way. And then, of course, gold actually ended up taking off. So it's looking like the macros are shifting a little bit. So we'll probably see gold kind of pop in here in a little bit because it does look like we're going to get a slight amount of reacceleration with the Federal Reserve actually easing into that, which is crazy. And yes, that is a perfect situation for gold to go straight up. So that's probably what it's doing. The market's reacting a little bit earlier before the macros kick in, which is fine. It just means that we kind of missed the turn just a little bit here. But we will still catch the trend. So overall, you can see here. Overall, you can see here we've got our current allocation of 50% in SPY, 6% in TLT, which that's the 20-year bonds, and then 32% in UUP and 8% in IWM. So 4% in EEM over here. Typically, UUP and EEM kind of balance each other out. So you can kind of see that as like a diversified holdings right there. And then typically IWM and bonds kind of typically balance themselves out. So if you kind of really think about it, we're about 50% invested in some way, shape, or form. You can kind of keep that with a little bit in mind, and then a little bit of extra cash on the sidelines for the dollar. Now, leverage under high water right here. This is something that I said we'd talk about. So the concept behind leverage under high water was when I originally released this system over at aramir.com. Definitely kudos to Tom over there at aramir.com. He's awesome. He was the person that originally got this system available to the retail public, so that was kind of cool. Anyways, the members over there, which are brilliant people, it's amazing how brilliant the traders are over there at Aramir. They wanted a little bit more, right? They wanted, hey, how do we like leverage this up without taking as much risk? Blah blah blah. So I pitched out the idea of leveraging up during drawdowns, which is something that I've done in some of my other strategies, and it's kind of like buying the dips, right? Except with leverage. So what you do is, as the asset or as the sleep portfolio draws down, you typically leverage up, and as it draws down more, you leverage up more, and then there's a limit. So basically, there's a 2x leverage, and then there's a 3x leverage. Not each one of these will leverage up that much. It's actually 3x leveraged SPY, 3x leveraged TLT, 2x leveraged GLD, just the 1x leveraged UUP, 3x leveraged IWM, and 1x leveraged EEM is the actual combination that you leverage these up at, depending on how much of a leverage ratio you have. So like I said, 2x and 3x. Well, when you get up to a new high water in the base portfolio, the unleveraged portfolio, you deleverage. So like I said, there's been a lot of people that have taken our returns that have been roughly, I think, 20%, roughly from the bottom, I think, about 20% from the bottom, and have actually increased that significantly because of that leveraging under high water. So I just wanted to let you guys know about that, just in case you're not aware of that little strategy. It's pretty awesome. So now that we're up to a new high, everyone starts out fresh, and then once we draw down, you can, of course, increase it, right? Which actually, as of this next week, if we stay down, we will actually have tagged a low again, or not a low, but it'll tag that first limit, so we'd leverage up again. All right, let's move on to just looking at the scoreboard up here. 36% total return is what we've gotten so far. We did, like I said, just recently tag a new high intro week, so I would just consider that as a deleverage. That's fine. And then we just pulled back just a little bit here today. So no big deal. Cranking up, everything is doing really solid. And I believe that is an outdated chart. Yeah, I did not grab that new chart right there. These are the new numbers, but that is an old chart. So we're actually a little bit higher than this. That's why I said we're at a new high, and the market is actually a little bit higher as well. So sleep all portfolio 36.8, 1.19 for the month so far. Mr. RPAR over here, I adjusted for dividends because someone asked me about that. So adjusted for dividends, it's actually down 7.76. Total return since we started this portfolio along the same time as RPAR, which is an ETF that follows risk parity. And then you can see that they actually had a little bit of a stinger of a month on their end. And that's just predominantly because of bonds. Awake is a whole nother animal. This thing got a little bit chopped up. We'll talk about this. Nothing like it hasn't happened before, but it did exceed its max drawdown. So that is one of our little first red flags that we have. So just keep in mind that that's there, right? And so we're monitoring this guy. We want to see it come back and come back to life. But it does have little one warning flag up, and I'm watching it. So just to see if something's changed, I have looked at the algorithms. I have looked at the allocations. Everything is doing what it's supposed to be doing. It's just, it really did get stung on that 3x leveraged IWM. And it was just 1 week, and there's almost nothing that you could do to kind of miss that, algorithmically, or even just it's just how the system kind of worked. No big deal. I'll show you the graph on the next thing. It is a little bit of a stinger, but we'll recover from it, no problem. I mean, we've had 100% years in this strategy, so no big deal. As far as our allocation right now, 61%. The TMF, which is the leveraged bonds, is 6%. 2x leveraged gold is 18. Like I said, this is 3x leveraged right now. If When we recover and we pop back up near the highs, you'll see that 3x leverage drop down to 1x, and we'll just kind of move on from there. So that's typically how the system works. As far as today was a little bit of a doozy for this guy because we are 61% UPRO and 14% URTY, which is IWM and SPY. They are 3x leveraged, so they are going to sting when they go down. We did go down, what is it? I think a full 1% today in the S&P and something close to that in the Russell. So a little bit of a stinger today, but that's off of the back of a strong week that we had last week, which you can see on the graph here. Like I said, we shot up from the bottom. This is us exceeding our max drawdown right there for 1 week. Pop back up, and we are climbing from here. The total return for the Awake is a dismal 13.67. For us being leveraged 3x through a recession, that is actually pretty awesome, but I would like to see this thing hit new highs. To be honest with you guys, it will get there, just it's not doing it right now. It will in the future. Here, I'd probably say typically when we hit these lows, you can see how fast it recovers, sometimes really quickly. We could pop back up here probably within the next couple weeks, depending on what goes on. If we end up getting a reduction in allocation to the SPY, leverage up into, like, let's say gold and bonds as the Fed ends up actually easing, we could pop up to new highs and actually make some serious returns really quickly. So that is a play that could actually happen there. The S&P, meanwhile, at the same time that we started this, has actually performed 7% to the upside. What a script flipped, right? We were actually almost pushing into new highs when the S&P was down 24%, right? And now the S&P has fully recovered and we're actually at our lows. So this is one thing. Talk about some uncorrelation, right? So that is something that has been kind of an interesting play out. Now that we're adapted over to the new macro cycle and everything like that, we're a little bit more in tandem and stabilized, but it was a little bit of a stinger when that happened. Alrighty then, the Sleepwell asset visual. So we're going to just dig into really what's going on. Like I said, here's gold back here, man. Gold had a stellar couple days, right? It's been like 3 days. That thing went straight up. Talk about some epicness, right? So the dollar, gold, 15% up since the recession. These two have really been the powerhouses. You can see that they've been inversely correlated to each other too, right? As one goes up, the other one goes down. As one goes down, the other one goes up. So it's really hard to basically be in both the dollar and gold at the same time because you basically just get chopped up the whole time and it just sucks all your profits out. So that has been part of the challenge since the recession, just to kind of deal with that. The Sleepwell portfolio, meanwhile, since the bottom of the recession, is just up a few percent. We're just behind the S&P right here. So we're about like right at this level. So we've been doing really well. We also took less of a drawdown than any other asset on this screen. So that is the bonus of the Sleepwell portfolio and how it was managed. So it did really awesome because the S&P over here, IWM, I mean, don't even talk about bonds, right? That was like a 45, almost a 43% drawdown in bonds, right? Huge drawdowns in some of these assets. We didn't even come close to any of that in the Sleepwell portfolio. So been epic through that. But as you can see here, 17, 15, 5, right? 5.9 for the, or minus 5.9 for IWM. So IWM hasn't fully recovered since the beginning of the recession yet, unlike us and the Sleepwell and us and the S&P and then gold and UP. The EEM over here is still down 14%, so way below even where our lowest point is, and is in fact actually down as much as where the Awake is. But of course, EEM isn't leveraged like the Awake, so it can't recover as fast. RPAR down here at a nasty 18.9, but keep in mind, I don't believe, I actually did. Oop, hold on just a second. I actually did account for dividends and things. So that is actually a legit 18.9 is how much that's been pulled down. The TLT is nastily down here at 31% down. So yes, we've had some recovery in this, and that's been phenomenal. But at the same time, it's still down 31% from its highs before the recession kicked in. So as far as the S&P, where is it at? Like, we're going into each individual asset now. Here's the recession that kicked in. Here's been the recovery so far. We'll talk about more about this later on, as we've talked about in previous months. But very, very, very clearly, this has been pumped up by a lot of printing that's been going on in the background and a lot of monetization of debt from the federal government. So this is not a real economic expansion right here. It is a asset inflationary expansion. So that has been part of the challenge, but yet also part of the awesomeness of being able to go long, and what brought the Sleepwell portfolio up to its new highs, things like that, right? We're in this train in the Sleepwell portfolio, making some money. Everything's great. But we also know that it's also like a fake or phony rally, right? Very much like just being pumped up. That does mean that when we do have the recession that we're in and continuing to go in, it will be a little bit of a different animal back here, because we're starting up from such a high level because of the pumped up $3 trillion pumped into the reverse repo market, and then a ton of money going into defense contracts for other countries, and then being reverted back into defense companies in the U.S. and things like that. So there's been lots of ways that we've been printing and monetizing money and pushing it into the economy here to try to pump it up. And it's not even we are pumping it up, but there are things that are going to be challenges because of that. We'll talk about that later too. So the S&P has been the primary beneficiary of that, because typically whenever we do monetization of debt or any such things, typically it goes into the largest companies first and the most stable companies first, especially in recessions. But as the recession turns over and we go into an actual growth phase, you'll see small caps will take it from there, and they'll launch. All right. Oop, skip one. TLT. So this is our 20-year bond. Typically, the bond is the way to, or it is the asset to go when you have a recession. Not because of, I think, what some medias tell us, which is like, hey, it's a safe haven, everyone runs to bonds. No, 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 no. That is total garbage. What actually goes on in the bond world is when you have the elements that create a bond boom, you push into there, right? So if the yields are higher in bonds, they become more attractive. If the growth in stocks is subpar or lower than what those yields are offering, right? So it's naturally going to pull money in from stocks going into bonds. Then at the same time, you'd also be attracted to bonds down here when bonds are lowering in interest rates, because when they are lowering in interest rates, the face value of the bond or the treasury actually becomes more beneficial to you as an owner of that bond. So it's kind of like a tailwind, right? So not only do you get the rate, but then also, since your rate is better than all the other rates offered right now, people will pay you an extra bonus on top of your the face value of it. So that's when it's a good time to be an owner of bonds. So you get these bond bull markets, and that's really what pushes these around, is the rates going up and down, not necessarily just the pure rate itself. But it does help us, of course, to just get the straight up return from the rate. Now, as the what drives rates is really what's important. Unlike stocks, where stocks depend on growth and or nowadays fresh new printed money coming in from our governments, that's really where stocks like to have their growth from. As far as bonds, bonds care about inflation, right? They care all about inflation. That's the only thing they care about, sort of. Of course, that and whether the government can actually pay the debt. That those are two different stories. Which, by the way, we're not even close to that. It's not even a problem. So we're not even going to talk about that. I know there's a lot of conspiracy out there, but no, it's fine. We're not even close to that issue. Now, there might be some liquidity drying up, but I mean, it's not that we can't pay it. We'll figure it out. The point is that they care about interest rates and interest rates and inflation. As inflation accelerates or decelerates, bond yields will go up or down. So as inflation cools off, typically you'll see bond yields drop and you'll see bonds actually go up, right? And so that's going to be kind of your bonus. The reason why people use bonds in recessions is because typically we get deflation in a recession because not as many people are buying things. And when that happens and you get a lowering in inflation and you get this deflation, bond yields start to crash and crater. And so it's really typically a good time to be in bonds. Of course, the Federal Reserve will also drop interest rates as well, which can kind of spur things up, but then, of course, creates inflation in itself. So that is the reason why. When we are in an inflationary recession, like what we've been in, this is not as attractive as an asset. So you're very limited in how you can move in this type of recession, which is why you saw back here, we were not in bonds through that whole cratering process, which is why the 60/40, RPAR, all of those types of things, all those types of portfolios just got hammered and we didn't because we adapted to the current macro environment. That's what we do. All right. Here's Mr. Gold back here. You can see where a lot of the growth has came from. It's been the devaluation of the US dollar on a hard asset basis, right? So the gold is being pumped up and pumped up and pumped up. It's just how it is, right? Now, we were positioning a little bit more for stocks and bonds, and then here recently, gold has really gone up. But we've had a little bit of good times from gold that has propped up the portfolio as well, so that we've been benefited from that. And we'll see more of it too. Probably, especially with it breaking out to do highs. I know that the macro triggers are definitely signaling, like I said, we are having a reacceleration in inflation with the higher probability of interest rates coming down due to longer term disinflationary pressures. So if those two match up and continue to match up like they are showing they will, likely next week or the week after, we'll start seeing some gold allocations. So just know that they are coming. Like I said, the market's just reacting a little bit early, so someone's got a better algorithm, right? All right, here we go. This is the U.S. dollar. The U.S. dollar gains strength when the Federal Reserve is tightening. So whenever you get a reduction of interest rate cuts or some sort of tightening process, typically the Federal Reserve or the U.S. dollar benefits from that. This is why we use the U.S. dollar a lot through this type of the cycle. Even though we got a little chopped on the way down, which was fine, that's part of the process. We did use it a lot for our hedging rather than bonds. That's why we were able to do what we did. And we ended up hitting new highs in that June time period. I think it was June. Yeah, June, right here, where the market was hitting its lows. We were actually hitting our highs in the Sleep Well portfolio. So same concept. The dollar is continuing to push higher as the Federal Reserve remains tight, or if they remain tight, the dollar will continue to kind of somewhat strengthen, especially as liquidity continues to dry up. If the Federal Reserve starts to drop interest rates, which they are likely to do, then we will likely see the dollar start to have some issues and gold go very aggressively to the upside. So we'll see how this plays out, and we'll see when they signal that they're going to. That's going to be a large component of how we move our assets moving forward. Is going to be basically what their setup is, what their dot plots are, their dot plots are kind of funny, but what their projections are and how it's going to impact assets, right? So now we've got IWM, which the IWM always trails during a time period of just massive amounts of printing from the Federal Reserve. We've had a lot of printing from the Federal Reserve starting here in April of 2023, right? And this is really where things should have been continuing to kind of go south and us be kind of chugging along in this area. This is really where the market wanted to be. But because of all the printing, you can see that we've been pushed up higher and higher and higher into this area of kind of this bubble land. And we can call it like the reverse repo bubble, or we can call it the government spending bubble, or whatever we want, whatever bubble we want to call it, right? It's just another bubble. And so you can see that it's been pushed a little bit too artificially high. Of course, large caps are the main beneficiary. Small caps don't benefit as much just because they're 100%, they're most of the time very domestic, whereas large caps have the benefit of taking that excess printing and being able to take advantage of the world economy versus just the US economy. So when you get something printed up beyond its natural level through debt monetization, and there's not a ton of actual economic growth, you'll see it in large caps more than you'll see it in small caps just as an asset. So that's what we've seen. Like I said, a little bit of this printing has actually helped out, right? You can see from the lows here, we have actually popped up quite a bit, even in small caps. So some of that has leaked into small caps, which is a positive thing. But as I said, we go into the later half of this recession, and we'll likely see this kind of chop out and have a deal unless the Federal Reserve pulls some other levers. And we'll talk about that as well as we get into further into macros. EEM, of course, is not part of the U.S., right? Those are emerging markets. So everything that we've done in the U.S. as far as all of our printing does not benefit the emerging markets. So this is kind of more like a raw look at really what the growth is like in the global economy. It's not very good, right? It really hasn't recovered. It's not peaches and rainbows like what it's showing over here in the U.S. This is pure manipulation from being the Federal Reserve or being the reserve currency. It's just what we've done historically, and we're doing it again. But this is 100%. You can see right here what the being the reserve currency and being able to print money into existence and being able to spend it freely without cratering your currency. This is exactly what that's done. So, yeah. Meanwhile, like I said, we really should have been somewhere near where we are. Like I said, some little bit of recovery, but not much. All right. As far as the sleep well portfolio, like I said, we were up a little bit, 1%. SPX 4.5 for the month, or roughly 4. IWM 4, gold 4, EEM about 3. A lot of the stocks did really well this week. What really got us a little bit was early movement in gold earlier in the month, and then a little bit in TLT. That's totally okay. That's part of diversifying, right? You're going to be wrong on part of your portfolio and right on part of your portfolio. And we're nice and steady Eddie right here, making some good money. So that is where we're at. And pumped up some positives for the month in both portfolios. I very much look forward to Awake cranking it up at 3x and getting us some nice bullish moves. I have pointed this out before that this is very, 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 very similar to the time periods of late 2019. I'm going to just reiterate that again. What happened in late 2019 was the quote-unquote not QE time period. It pumps the markets up really aggressively. It also leaves them a little bit top-heavy per se. So catalysts can bring it down, but they don't come down immediately. The only reason why this came down so aggressively during COVID, of course, is because we had a worldwide pandemic, for crying out loud. Stopped all growth, everything, all instantaneously in the very moment. That's not something that's very common, right? So I wouldn't expect that to happen again. But definitely anything like what happened in late 2018, where we kind of had this rollover type of recession, something like that. Very, very common, right? That's kind of what we typically see in this time period. Also, what sparked that in like 2007, 2008 period, same exact concept, right? This not QE type of thing. It's this inflationary thing. Although, of course, in 2007 and 2008, You had the bubble of the housing market and all that stuff, which we do have bubbles in some of those assets, and there are there are signs that large real estate holders institutionally are actually looking and trying to figure out how to liquidate some of those assets strategically. So just know that that's coming down the pipe, but it's not here yet, right? Right now, they are looking at it and they know that the risk is on the table. So over the next coming years, there will likely be a flood of some inventory coming on the market as far as the housing market. But we'll talk about that later. I'm not as mm, I'm not as proficient at measuring the housing market as I am certain assets, right? Macro assets specifically, but they still have an effect. So I do kind of know what's going on in that world. I'm just not as good at it, right? So just keep it, take whatever I say with a little bit of a grain of salt. We'll just let the data show itself. All right. So this we're going into our macros, right? So here we go. We're like really digging deep. Take a second, let all that absorb in, like I just said, and then we are going to dig into the macros. What has been driving the market? I've been sprinkling it in so far. Now I'm going to get a little bit deeper. We're going to get some data. We're going to see where things are going. We're going to see what money is there and where's money flowing. All right. First and foremost, we've got to talk about the reverse repo market. I mean, come on. The reverse repo market by far is the best teller of where the money is coming from and whether we're still printing it or not, right? We have absolutely been monetizing the debt that the government has been spending because there hasn't been enough demand for treasuries at these interest rates. So we're printing it through the Federal Reserve. We did this through pumping up what's called the reverse repo market. We basically flooded our banks with too much cash. They ended up piling it into the reverse repo market. And then as treasuries uh, become less attractive and there's not enough buyers, naturally what those banks will do is they'll pull it out of the reverse repo market and go into treasuries that are yielding more than the reverse repo market. It's just a mechanism that the Fed has set up this time around. In previous recessions, they did not do it like this. This is the very first time that we've been seeing them do it in this manner. Typically, what they've done is they've just grown their balance sheet and actually have just bought assets. This is not what they did this time. Like I said, they did all this earlier during COVID, and now it's kind of working its way out. This has been, as I said, started in April of 2023 is when this has been pumped up. This is when the divergence from the global economy and the localized economy, which is like the U.S. economy, of course, has separated themselves. This is way, way, way higher. The stocks are way higher than what the actual economics underlying will merit it for, but not what the amount of printing has merited it for, right? There's been a lot of new money being pumped into markets and a lot of leverage. And remember, as printing into treasuries, that ends up translating into a leverage coefficient into risk assets like stocks. So every $1 printed into treasuries is typically like $5 to maybe even $10 printed into the stock market. So fun stuff. I've got this on another page too. So this, the big question in our heads probably should be, how much money is left, right? And I mean, you can see this over here on this very far scale, right? This actually got all the way up to about 2.5 trillion at one point, and has leaked all the way down to 439 billion. This chart basically shows the same thing, right? 2.5, 2.6 trillion at the high end. This is the reverse repo market. And we've seen it drain and drain and drain and put new money into the economy or into the treasury market. And you can see that it's kind of slowing down, right? It's just a little bit slowing down as there's a little bit more demands for bonds again and treasuries because inflation's cooling off. This is exactly what the Federal Reserve was planning to do They plan this to a T. They are some brilliant, brilliant group of people. No matter what anyone says about them, this was a freaking magic act. This was amazing that they were able to do this. And this system whoever came up with this system was just brilliant. Financial engineering at the peak. Woo! Gotta love it. All right. So what they did is they drained this now. And now that we're at 400, we are getting to the limit here, or I shouldn't say to the limit, but to the end of where the reverse repo market can really come into play. From that point, the Federal Reserve will have to make a decision. That decision will be, do they drop interest rates or grow their own balance sheet to kind of keep the pump going, or do they let it all simmer out and kind of crash itself, right? Most of the time, they continue the pump, right? That's just historically what they've been doing. We'll see. But if they actually, keep interest rates where they're at and they let the back end of the yield curve pump up and then reinflation or reacceleration of inflation comes in, and then we eventually get a lack of demand from buyers, and then, of course, that ends up turning into a full-out recession, then, we'll see how that goes. So we'll just kind of see how they play it. But either way, we've got about $400 billion left in this account. What that's done historically is it's pushed the market up by about 10 to 15%. So just know that we've got another 10 to 15% to the upside potential just from the money coming in from the reverse repo market. So woohoo, we're not at the top yet per the reverse repo market. It doesn't mean that we can't be, right? The recession can kick in, the unemployment can kick in, those types of things. But the likelihood is very low right now while the Fed put is in place and while there's still a bunch of money sitting back in this account. U.S. Treasury yields, 10-year, 3-month spread, right? We're looking at the inversion. Everyone freaks out about the inversion of the yield spread. As I've said before, no reason to be freaked out about the inversion of the yield curve. It's like whatever. Like, it's there. It's just it's an inflationary measurement that the closer dated inflation is higher than the expected long-term inflation. So we get an inverted yield curve. Typically, it does precede a recession because typically the Federal Reserve likes to tighten interest rates and basically kind of crash the economy when we get inflation too high, and that actually slows growth down. This is, of course, very different. This is very similar to the 70s types of inversion, when the inflation itself is the actual problem, not a like a low growth inflationary type of environment. We have a crazy, crazy hot inflation metric, crazy, crazy hot economy, and so it takes a while for that to work itself out. So typically you invert the yield curve pretty strongly, and it is inverted very, very, very strongly right now. The recession typically kicks in when you get an uninversion of the yield curve, right? Typically it's on its way down that the recession kicks in. Boom, recession, boom, recession, boom, recession. So we aren't there yet. We're not there, right? So boom, you get the uninversion, and we actually get the recession during the uninversion. That is typically how it kind of happens in these inflationary recessions. So we did start having a little bit of uninversion. If we actually get a full, more of an uninversion because it's like this inflationary cycle back here, I would say that we're probably entering the recession, and assets will probably act accordingly, which means selling off. The federal funds target rate has stopped and slowed down, so it looks like they're done at the end of their cycle. At least it looks that way. Doesn't mean that they are. It doesn't mean that they're going to drop it. Doesn't mean that, whatever. But it is typically that they are kind of chilled out right now. They're doing a wait and see approach, and we'll see if they end up getting what they like. They have been signaling that inflation is sticking a little bit stronger than they anticipated. And so they're looking at holding interest rates higher for longer, and that's why they cut out a yield curve or they cut out a rate hike this next month, and we'll see if they take out another one. Federal Reserve Jerome Powell is speaking tomorrow, and I think Thursday or Friday. He's speaking twice this week. So we'll see what he says. Most likely he'll say one thing one day, and he'll say another thing the next day, and so the market will react probably both ways. does all sorts of fun things when he talks. So, one very, very, very powerful person speaking right now as far as the markets are concerned, because everything is hinged on what the Federal Reserve did, because it's been an engineered recession. It has not been a slowing growth recession. It has been an engineered recession. And that's very different than the recession that we got in '08 or .com, right? This is a engineered recession. And so because it's an engineered recession, they have been able to, pump us up and keep us kind of more stable than normal. All right. Because they're creating rather than reacting, right? By the way, slowing growth recessions like what happened in '08, the Federal Reserve is reacting to a slowing growth. And so they kind of have to spur inflation. They kind of have to do everything in their power. And so the recession kicks in first, and then they try to come back. This time around, they kind of created the recession through this, and then they basically can say when it's going to stop. So it's very much hinged on what they're going to say. Current Treasury yield curves, you can see basically the belly is still pulled down. The bond market, even though it did lift just a little bit over this last month, right? The bond market really does want the Federal Reserve to drop interest rates, right? With them being down here, somewhere around this 4% marker, and the shorter end being up here almost at 6%. They really do want the Federal Reserve to drop interest rates. And that will pull the Federal Reserve down. As I've always said, the Federal Reserve doesn't lead the market leads the Federal Reserve. Even though they speak like they do the opposite, it's very much different. So the bond market is trying to pull the Federal Reserve down, and we'll see what they end up doing. Odds of recession, this is part of the yield curve, or it's a derivative of the yield curve. So it's going to be high, but like I said, it's the uninversion that actually is normally the troublemaker, right? You can see that uninversion coming in, uninversion. Buffett indicator, I love this thing, right? The Buffett indicator always tells us how expensive is the stocks versus the GDP. All right, stocks versus GDP, you can definitely see right here that we are starting to get a little bit lofty again, right? We're starting to crank up there. Things are getting a little expensive. Basically, very similar to what we had before every single recession in the late '60s, and definitely where we weren't as expensive as what we were prior to the bubble pop in 2022 or .com, but we are getting pretty lofty right there. So it is starting to get a little expensive out there, at least per this metric. As far as PE ratios, right, we're around the same. One thing that I do like to look at every now and then is, of course, the relative value of the S&P to interest rates. So something that I don't explain about this very often is basically what happens is when interest rates are very high, then the growth of the stock market, right, the stock market earnings growth and the returns of stocks really have to be very high to merit those prices, right? And so what ends up happening is as yields back here, right? You can see that in this kind of pink line back here. As yields get very high, right? Stock valuations need to really crater because they're not as attractive as what you can get in the bond market, right? And so you can see that relativity is kind of going along here, right? And so as the stock market pumps higher on a price to earnings ratio, right? As it starts to pump higher, you can also see that if yields start to pump higher too, you can see that they're starting to get a little bit overvalued. Now, typically above one standard deviation, right, is enough to have it kind of roll over. And you can see we're actually more overvalued than what we were based on interest rates than what we were back in '08, right? And, 90s and even before the 1980 deal, that whole meltdown. We're getting pretty close to these levels. So that's kind of a little bit of a red flag, right? We're getting pretty expensive for interest rates. So if interest rates actually do come down, right, bonds will become very attractive in the very short term. And then stocks would actually become a little bit we likely there would be capital flow that would come out of stocks, and then eventually it would make stocks more attractive again, and then it would spike back up. But either way, right now, stocks are a little bit less attractive historically, right? Being close to this one standard deviation overvalued marker. Of course, state coincidence index, man. I mean, hey, we've got some recovery, but still, this is very high. These are the amount of states that are seeing recessionary indicators in their states or economic contractions in their states. Basically, every time we've ever been up here, we've had a recession, right? Here's 2022, here's 2020, here's 08, here's .com. By all measures, like we are absolutely in a recession right now. The only thing that's telling us we're not in a recession is the stock market and the quote unquote GDP, but it's it's kind of being pumped up artificially right now through government spending. So keep in mind that these are very much economic indicators right here showing that we're having some struggles. You can see here, this is the 12-month percentage change for consumer price index. Here we are rolling over from the quote unquote battle of inflation and has cooled down. Here is our victory dance. Not so much, because you can see here this stalling out. You can see the inflation stalling out. We really want this to come sub 2%, supposedly, is what they're looking for. And we are definitely not there yet. So the job is not done, quote unquote. But if we do end up going through a recession over the next 3 to 6 months, or a deeper part of the recession, this will have actually done its job, because it will cut down, because the spending and economy / unemployment will end up spiking. All right, Fed GDP now is almost, man, when they started out, whenever I talked to you guys last month, remember I was like, holy crap, they are crazy high for this quarter. My projections were down here. And they have actually came back in line with about where my projections are. I'm sitting right here at about 1.9, so almost right here in the middle of the meat of where the blue chip consensus is. So we'll see if they end up coming down to where mine are, or if mine end up coming down to, or coming up to them by the end of the quarter. Originally, I had us sitting at a negative for this quarter, and then as the quarter has climbed along, it has slowly but surely pulled mine up, very similar to kind of like the blue chips right here as we've gone further and further in. The amount of printing, I cannot stress this enough, the amount of printing and spending from the federal government has just been incredible to keep this thing pumped up. So very kind of cool what they've done. But we can see here delinquency on commercial credit card loans, or on commercial loans, and this is all commercial banks. We can see that we are getting a rise in delinquencies, far beyond anything we've seen since 2012. Now, we can go back here and we can look at, well, okay, yeah, but we're not, as high as what we were in .com or blah, blah. Either way, this is a lot of credit delinquencies starting to show up. So this is starting to get at a higher rate of these. And this is typically some of your first signs that you're getting into some economic turmoils, right? We saw this late in the .com, or late in the 90s era. And then we definitely saw this coming into 08 when the credit crunch was starting to kind of show up, these rise in delinquencies. Now, one thing on a positive note is the banks that are tightening standards, yet it is still positive, right? So percentage of banks tightening is less than what it was, but it's still positive, right? So there are more banks still tightening standards. Typically, we do want to see this coming down pretty strongly, which it has been. So that's a positive thing, which also leads to monetary expansion, which leads to inflation. So that's kind of a problem, right? Because we're trying to stop inflation, but yet banks are now loosening credit. As soon as you have a loosening of credit conditions, you get a resurgence of inflation, which is going to make the Federal Reserve go, well, I guess we got to keep interest rates up, or we've got to stop printing from the reverse repo market, or whatever, right? We got to tighten things longer. And that would be a bullish indication for UUP. It'd be very bearish for bonds. It'd be very bearish for gold. It'd be very, typically bearish for stocks too, right? So we'd go into another cycle of what we had in 2022 if this continues to go down this path. We do not want to see a easing of credit conditions while our inflation is still above the average. So we would like this to go the other direction. Since we haven't been seeing that, there is a high probability the Federal Reserve will not ease as much. And if they don't ease as much, we will likely dip into the meat of the recession, which would be like the last hurrah. That would really kick inflation's ass. That's looking like what we're going to do. But of course, I'm kind of projecting and kind of like speculating. We will have to see what actually goes on. But this is one of those levers that we really don't want to see being hit yet. And the banks are ahead of the Federal Reserve, and that's not a good thing. The Federal Reserve doesn't like that and will likely retighten. So here we are with unemployment. One thing that we keep in mind is unemployment going down or is unemployment rising? We are getting a rise in unemployment, yet again, signaling that we are going into a recession. And there's also a lot of unemployment that isn't registered anymore because of gig economies and all that kind of jazz. So keep that in mind, that this number is very different than how it used to be measured. So the fact that we're getting a rise in this is not a good sign for the economy, but could be a good sign for inflation, because if you don't have a job, you can't spend as much money. So, there's this tug and pull going on, right? Credit conditions easing, unemployment actually starting to go up. So a little bit of a tug and pull. Here we are on the M2 money supply. I've got a different chart, so I kind of flip back and forth between these, right? This is basically just telling us, is money supply accelerating or decelerating, right? And you can see here on money supply, typically it just kind of cruises up at a typical pace. And that's what this positive line is signaling. It's just kind of cruising up, right, at about 5%. Yeah. Keep in mind, this is the money supply, right? Inflation at 2%. Yeah, I don't think so. Money supply has been growing at 5% per year for a very long time. And that's probably a little bit more in line with what a lot of you guys know for prices, right? If you bought something back in 2011 and it cranks up at 5% per year, right? It's doubling quite more often than if it were at 2%, like inflation would say that it is. Yeah. So 5% is really what our inflation has been at. And then it got up all the way to 20%, which I'm sure you guys would probably agree with that, because, price of eggs, all that kind of stuff. So yeah, inflation was up very high. The M2 money supply cranked up. And then we tried to kill it off, right? We tried to cool it off. And you can see that if you were to take this average and split the difference, we're right here at about 10%. We want this to stay lower for longer, but you can see that we're starting to get a little bit of a lift. You can see that as this was dropping down, positive, right? That's a good thing for inflation, cooling this off. M2 is the amount of money in people's bank accounts. As this cools off, that's a positive thing. But you can see that we're starting to lift up here right at the end. We're starting to get a resurgence in inflation. This, yet again, signaling from domestic banks loosening credit conditions, those types of things, right? Not tightening anymore. This is going to create that second wave of inflation. Not a positive aspect. Here we are on the home affordability metric or monitor. This homeownership affordability monitor, let me get that right? This is basically just showing that home ownership has gotten an eensy-weensy bit more affordable. For some, right? Definitely nothing like it was in 2000s or 2017 or, even in 2011 or anything like that. Nothing like any of this, right? When we get up into these 100%, houses can go up in prices very quickly, no problem. So what's driving the home prices now? That's a lot of speculation. It's all about a lack of inventory and manipulation in the housing market and price fixing, which there's quite a bit of lawsuits right now about price fixing. So yeah, that's a thing. Yes, it's kind of jacked up that's happened, but there's a lot of artificial home prices out there. So yeah, it's quite interesting how it's starting to happen. But basically, we're starting to see a lot of what is, keeping the home prices up that don't quite make sense because there's not actual buyers out there, but there are some. So, it's quite interesting. So we'll see how this all unfolds. But either way, as it stands right now, this is far, 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 far below where people can actually afford prices. So what we did back in '07 to keep the pump up in the home prices is we offered special deals to like lower income, and we offered all these special deals out there to try to get people to get into these homes that they couldn't afford, because everyone wants a home. Everyone wants to buy a home. Everyone wants to be a homeowner. That's the American way. That's how you make your retirement. That's how you blah, 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 right? Like that's the whole spiel that we've been all fed, right? The deal is that when they're this unaffordable, it's very hard for them to go up in price because you don't have any buyers left, right? Unless businesses are buying. But then at the same time, we're starting to get bills starting to show up in Congress trying to push these institutional buyers and these businesses, especially hedge funds, out of the single family home market. So just keep in mind that that's there, right? There is a cry for help, and it is known that it's real estate interest trusts and hedge funds that have been pushing this to where the American middle family or middle class family cannot afford a home anymore. So, anyways, keep that in mind. And you can see some improvements, right? Little clicks, things like that, but we're still nowhere near where we need to be to see some actual home price growth. In fact, we didn't hit the bottom until 2011 ish in the housing market, right? And that was when we first started clipping into green. So keep that in mind. Lots and lots and lots of bullishness out there. Oh my gosh. Everyone thinks the market is going up forever. So 46%, 44, 42, 49. I mean, 4 straight weeks of the market is going up forever. 21%, one of the lowest readings that we've ever had. 21% say it's bearish, right? So sentiment index is crazy, 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 crazy bullish right now. Where are all the buyers going to come from? It has to come from credit conditions, right? That's the only way. You've got to loosen credit and print more money in order for the market to go up anymore. So that's why we pay attention to the reverse repo market. That's why we pay attention to credit conditions. Right now, it's more neutral-esque this week, by the way, in macro conditions. Those of you guys that are subscribed to the Adapt Advance, you guys know what my macro indicator is saying right now. But really, it's very neutral, right? It's been bullish and neutral bullish for a long time. It is now neutral, right? So we're kind of in this moment where things are kind of cooling off a little bit. All right. We did have a little bit more loaning on Kiva, so we end up growing our housing. Like I said, I was going to focus a lot more on housing. We were very heavily weighted in agriculture and food, and so we're pushing a little bit more into housing and services. Probably housing and services will probably be where I push into a lot, just to kind of grow those types of businesses and needs. So it's been awesome. We get these little letters from people, right? That from the loans that we gave them and what they did, and provider assets and all sorts of good stuff. So really awesome. We're up in the 96th percentile, so it's pretty cool that we have been able to do what we've done. 26 countries, man. I mean, we are all around the world. All right, with that, let me go check on you guys and make sure I haven't seen anything pop through. No, looking good, guys. Okay, so I am going to wrap this up. And if there's any questions, I'll just kind of wait here for just a second, just in case there's some questions that pop through. All right, so wrapping up for the day. 100% here. Markets don't go up for forever, right? We know that we've been printing our way up. We know that printing still has gas in the tank, right? So there is a high probability that we will continue to stabilize or push up, and the markets aren't just going to go straight down. That's typically not historically how it works, especially if there's still gas in the tank. There's gas in the tank in many ways, right? Not only can the Federal Reserve continue to print out of the reverse repo market, they can stop tightening their balance sheet. They can drop interest rates. They can spur this thing to the freaking moon. Of course, it will increase inflation at the same time. So that's the balancing act right now. We want inflation to come down. If inflation comes down, then that means the Federal Reserve has a boatload of ammunition to deal with the next recession, and the risks get significantly mitigated. So, bullish thing for stocks. If the inflation continues to reaccelerate, the Federal Reserve will not be able to continue doing what they've been doing with printing through the Federal Reserve, and the government can't keep printing. Otherwise, we risk going through another inflation spike, which is really what it's looking like we're going through. Of course, the bond market isn't signaling that we're going to go through another inflation spike yet. So everything right now is sitting like peachy hunky dory. There's a Fed put in place. Everything can climb, and it can continue to get more expensive for longer. That's where we sit right now, right? So that's what the market is doing right now. We're not going to sit there and talk about what what crash types of situations, whatnot, and so forth. Right now, that's where we're at. As we check in on a week-to-week basis, as we look at the macros and we evaluate risks models, we will determine whether it needs to be de-risked or not, right? But mostly, everything is very bullish right now. And it continues to look like it'll continue to be that way, at least for the shorter term. All right. With that, guys, hopefully you guys have a great month. I wish you guys make a boatload of money. Enjoy the portfolios. Enjoy making some money. Hopefully you guys are having a great time trading. If you're trading with some of my systems over at Environmental Trading Edge, then awesome. You guys can always reach out to me. Wayne at aramir.com if you're from Aramir. If you're over at etradingedge.com, you can always, of course, reach out to me at Wayne at etradingedge.com. Alrighty then. I'll talk to you guys next month. Have a good one.